What's going on, guys? Credit Solutionist here, owner of PX Credit Solutions, where we help you secure your financial future today. As you guys know, I am the lead debt management strategist over at mycreditcall.com, where I help people just like you get rid of some of their debt and clean up their credit reports so you can actually get into the home of your dreams. So that's why I wanted to bring tonight's topic to you guys. In a groundbreaking move, the Federal Housing Finance Agency, or FHFA, has mandated that mortgage lenders that sell loans to Fannie Mae and Freddie Mac, which are government-sponsored enterprises, they have to adopt the VantageScore 4.0 model when considering you for a home loan. This is a positive for a lot of potential home buyers out there. But of course, I'm the credit solutionist and I have to look at all angles. And tonight we're going to dive into some of those. So as you're coming in, go ahead and like the stream. Let me know where you're watching from. And really, let me know what the housing market is looking like in your town. I would be so curious to know. Now, I read up about this a lot today, and I felt like I was going in circles because as soon as y'all know how I am, when I see big old print on a page and I see big old headlines and a bunch of YouTubers doing a video about a certain topic, I'm like, wait a minute now. Some of y'all are just looking for views because you're not telling the whole story and you're getting tens of thousands of views to lie to your public. The credit solutionist will not do that. And I have read over some of this and I'm going to share with you some of the discrepancies that I see and how I do think that on some level, we might be getting sold a bill of goods here. And yeah, I don't know. Something about it just doesn't sit right with me. But let me go ahead and just get into the facts of everything and we'll have a conversation. Now, traditionally, when you're applying for a home loan, you do have to use the FICO score. A lot of lenders or a lot of borrowers don't know, but whenever you apply for a home loan, they're basically using a FICO score that is the mortgage model. So let me see if I can share that on my screen here. If you go and you try to get a home loan, they are going to be looking at your FICO credit score, right? But they're only going to be looking at your FICO credit score for the mortgage version. So let me just break down some of the versions here so you can see what I'm talking about. So we have Experian, Equifax, and TransUnion, right? I showed you guys this on another live stream a few weeks ago where we talked about the different types of FICO scores that exist. You're probably only going to see this if you're watching from a TV or like a tablet or a laptop. I'm sorry for those of y'all that are watching from your phones, but anytime you go for a mortgage, you're going to be looking at your FICO 2 with Experian, your FICO 5 with Equifax, and then your FICO 4 with TransUnion. So what does that mean for you as the borrower? Well, it means that you've been looking in the wrong places this whole time anyway, and really didn't understand how your score was being calculated or determined to get a home in the first place. A lot of home loan originators and whatever, I believe that they bank off of that, but that's just a rumor. Now, with this change of the 4.0 Vantage score being implemented, it's taking away some of the stress and the restriction of the FICO scoring model because, it is a little restrictive. It is a little, confining when you really think about it. Because if you are the consumer, you're in the dark about what score is going to be used anyway. And with this 4.0 adoption, you're now a little more clear on what the qualifications are. So anyway, this change promises to give more individuals and families, including those that were previously underserved, I'm doing that in quotations, and newly scorable consumers, it's here to give them an opportunity to achieve the dream of home ownership. I have my doubts, but let's continue. This mandate supports the growth of mortgage lenders' portfolios. That's really what's happening here. Let me see if I can show you. So it shows that here, lenders can originate up to $1 trillion in new high-quality mortgage loans by being able to capture a market that's going to be introduced to them with this new VantageScore model. So that's really why this is happening, just so you guys know. With a larger pool of qualified borrowers and reduced barriers of entry, the lenders are going to end up being able to expand their lending activities, and they're going to be able to diversify their portfolios. I don't know if Diamond Dave is here, but I'm pretty sure he understands what I'm talking about. Now, when I looked at the information from VantageScore.com, which is here, it's available for all of y'all to check out. It literally breaks down for you. Yes, this is good for y'all, but it's going to be even better for the people that are investing in these home loans. Now, you will remember, as I was talking about the FICO, that for nearly 30 years, the government-sponsored enterprises, or GSEs, they've required that lenders deliver the credit scores based on a classic FICO model. So that's that FICO 2, that FICO 5 that we were talking about earlier. Now, you might ask yourself, okay, what is that even called? And it's called a tri-merge method. So what the tri-merge method is whenever they look at your credit score, like say you go to a lender and you apply, they're looking at all three of those FICO scores, they add them together, and then they come to an average. So the tri-method merge, y'all, tongue twister, tri-merge method. It is the standard, right? Now, I know that it could be shocking that that's been like the standard, but I think when you understand exactly how your scores work, it helps you in the home buying process. Now, with this new method, though, they're going from the tri method, which is the 3 reports, into what's called a buy method, which is a buy merge. It's going to be your FICO 10T, and it's going to be the VantageScore 4.0. So those two things. Now, even though it's a mandate, because I work in compliance also, I understand what that means. Typically, when there's a mandate, it just means that this is the bare minimum that you have to do, but you can also kind of fluff up and add a few more stipulations to your barrier of entry if you want to. But as the government, we only mandate that you use this bare minimum. That's going to be very, very important. So with this new method, lenders that are backed by Fannie and Freddie, they're going to use the 4.0 and the FICO 10T. But, and there's a big but, because these lenders still actually have the option. Let me see if I pulled it up. I think I might have closed it out already. But oh, here it is. So they have the option, even though they can use these two reports, they still have the option to use the tri-merge method. So while the FHFA and VantageScore 4.0, they're trying to tell you, yes, they're only going to use 2 reports now instead of 3. Y'all, that doesn't mean anything. I hope you're following what I'm saying right now. I know I'm kind of shooting off at the hip, but stay with me now. Stay with me, okay? Lenders still have the option to pull these 3 reports and continue to use the traditional tri-merge method and deny you. Okay. So while they're telling you on this website, yeah, we're gonna approve almost 5 million new borrowers. Yeah, right. I dig into the details so you don't have to. Now, they've only mandated that the specific reports are used at a minimum. Now, this is to create the hedge of protection around the lender, not around you as the borrower. Because, see, the lender, they have shareholders, which means they have people that they have to answer to. So they understand that each credit reporting agency also uses their own calculating method to calculate your credit score anyway. So let's say it this way. Let's say your TransUnion report has your highest credit score and you want to use that one for the approval of your home loan. Well, no dice, because TransUnion could be missing some credit accounts or some delinquencies that are reported on Experian and Equifax, right? So this is why we don't only use one report. You'll never in history ever find a mortgage loan that is going to be approved with just one credit bureau. You're just not going to find it. You have to remember the information that's reported on your credit report, it depends on if the creditor pays to report to that particular credit reporting agency, right? So I hope y'all understand why that is such a big deal. Now, the buy merge method to me, it sounds okay on the surface, but I had to think about a couple of factors that I couldn't wrap my mind around it, for lack of a better way to say it. So a couple of factors have to be considered when you're thinking about the buy merge method. Though there's one less required credit report, I'd be remiss if I didn't mention that the FICO 10T scoring model that is mandated is going to cause more denials or more scrutiny for certain borrowers, in my humble opinion. Now, if you go to the VantageScore website, they tell you that underserved communities, which means people of color, and I suspect that they also mean women, are underserved when it comes to home loans, right? But I wanted to break down the FICO 10T situation to kind of show you how limiting it actually might be for some borrowers, okay? Because the main point of this new scoring matrix that they're going to use, they're trying to say that, again, underserved, undercredited, people with thin credit profiles are going to be the ideal candidate. I'm going to read to you what the FICO 10T actually is, and I want you to tell me if this sounds like it's going to be beneficial for somebody with a thin credit profile or somebody that just got credit. Let's say that. So here, according to Investopedia, FICO 10T represents a new take on credit scoring with the use of trended data. That's an important phrase to remember with FICO 10T. They're basically looking at accounts for over 24 months or longer, including those that have carried a balance from month to month, or they're also looking at people that have consolidated their debt as well. So remember, debt consolidation as a whole is done because you cannot afford to pay your bills. So let's imagine that you actually did do a debt consolidation loan. That's going to be held against you, even though you paid off that credit and now you have a thin credit profile because you closed all of those accounts, right? So that's a ding. That actually doesn't look very good. So let's read the actual FICO 10T from the actual FICO website, because I don't want you to say that I'm making any of this up. So FICO 10T builds on the FICO score 10 by addressing the trended credit bureau data. That's that term again. The FICO 10T considers a longer historical time frame. It says the previous 24 months or longer. So that means that the lender doesn't have to look beyond 24 months. They could only look at that 24 months if they want to. So if you have a very thin credit profile, I'm not sure how that's going to benefit you. Or if you are a person that maybe had some credit, 3 years ago, but you don't have anything active right now, best of luck to you, right? So the trended data allows the credit scoring model to determine what your trend is. So how positive is it going to look if you're a person that hasn't had a credit account in 3 years? Yes, you have a 700 credit score, but you haven't shown us what your borrowing habits are like right now. So I'm sorry, the trend shows you back out when things get, when you pay off your bills, you back out, you're out of the game. And you being out of the game, regardless of your good credit score, if I was a shareholder, I'd look at you and say, hell to the nah, because you're not putting your money in the game. When you put your money into the credit game, you actually are playing in their system. That's why when you get one approval, it stands to reason you're going to get 5 or 6 more if you apply within a certain amount of time. So I hope that this is starting to make a little bit of sense. I mean, I don't know, y'all know I'll take you all around the world before I get to the point about something. But the FICO 10T model, since it only, really counts for the last 24 months, I just don't know how this is going to benefit certain people. So if you have little to no payment history, or you only have like 6 months on your credit profile, you're just not going to look like a viable candidate. Sadly, people of color are in this situation, as well as people that may be new to the country, as well as younger potential home buyers. Think recent college graduates, anybody that maybe graduated high school and maybe has a trust fund or something, right? Your credit profile is not looking that great. Now, though the FICO and the Vantage apply a different weight to the certain categories, still, I just don't see how this is going to benefit anybody in the long run. Now, Vantage promises with this change that about 2.7 million newly approved home loans will be put out into the market. But I wanted to break down the differences here. And really, I'm kind of like wanting to show you guys who they're actually talking about when it comes to these underserved people. Now, this is a group that is, they talk about it on the website here. So let's talk about that. They're saying 21% of millennials have thin files, which make it difficult for lenders to see them or us. I'm a millennial. They say it makes it hard to see us as strong borrowers, and it could lead to more young consumers not able to get the credit that they need. This is a bold-faced lie, because most millennials, well, not most, I'm not going to say that, but a good portion of millennials do have a credit profile, because they have those damn student loans, if y'all will remember. Yeah, we have student loans. And for those of us that didn't have student loans, we accrued debt by, let's say, having a car loan that had maybe, anywhere between 15 and 24%. And then we also had credit cards with super high interest rates. Millennials have credit. It's just that a lot of it isn't active because it's gone to collections. That's a big issue that a lot of millennials have. It's not that they're not getting credit. It's that the credit that we got, we screwed it up. Okay. Now I'm speaking as somebody that's in the market and in the business of helping millennials and even Gen X people. I'm helping them get out of debt and fix their credit. So when I see these numbers, it makes me laugh, because it just doesn't translate over into my business. Now let's talk about these newly scorable consumers that they're talking about. With this change of the VantageScore and FICO 10T being the two scoring methods, these folks are the market that they're trying to tackle are emerging borrowers, young files, and dormant consumers. So here's a breakdown of who those people are. Now, the first group is the emerging borrower or the young file. These people are considered young to credit. Now, why I would want to sign somebody on for a 30-year mortgage, whether it was fixed or adjusted, if they have a young credit profile, that's beyond me, because I don't know that they have the type of income that might substantiate this particular loan that they're trying to go for. But this group is comprised of people that are young to credit. So they're just starting their credit journey, or their accounts are less than 6 months old. They're what I would call the freshman market, only because they're just beginning to establish their credit history, or they've pretty much messed up like in the past, and now they have a brand new credit history that they're starting to build, right? Now, there is a pro to these kinds of people, because though they lack extensive credit experience, they do still present an opportunity for lenders to engage with them and then potentially maybe cultivate a long-term relationship, possibly. There's maybe two groups of people I can think of. I mentioned one earlier. I'm thinking young, higher income earners. So I'm looking at you guys, you tech people. And then I can also see it being somebody that's younger that maybe came into an inheritance of some type. Now, that kind of young credit profile, I could see that being an ideal candidate. Now, let's talk about the dormant consumers. Okay, so I'm going to highlight that here. And now these people, these are the folks that barely use their credit. Now they're here, but they don't really show themselves. You know that one meme where it's the guy, I think he's in like a yellow tuxedo or suit or whatever, and he's peeking from behind the tree, kind of rubbing his hands together with his tongue out. That's pretty much how they see y'all. You got credit, but you just creeping around, just, kind of wasting time, right? Now, these consumers, they don't have any recent updates on their credit files. And that's like within maybe the last 6 months, right? Again, I'm going to keep reminding you, remember, FICO 10T looks at the last 24 months. If you ain't done nothing in 6 months, that means we only have 18 months of credit history, right? 180 days is a long, 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 long time to be not doing anything, right? Now, let's say you have updates from the 6 months ago, like we talked about. Dormant consumers, these could be people that previously used the credit, they have it, but it's inactive. Now, this could be for a couple of reasons. It could be because the person doesn't want to carry a balance. That's a personal financial decision, right? Or for other personal reasons. Maybe they don't believe in credit, and maybe they just had to get it for some emergency situation. But believe it or not, some faiths do not allow people to have credit, right? Now, this could also be because some people go dormant because their income is also decreased. So think a recent retiree, or you could also think about a job loss, right? Because I know what a lot of my clients were doing, and what I did during the pandemic was I had a lot of credit that I was able to obtain, but I didn't necessarily use it because I didn't know what my income was going to look like as the months and the years kept going, right? Because it was really sketchy during the pandemic, y'all. Now, despite your dormant status, we're thinking about this like an investor. Despite the dormant status, you as a consumer, if you are dormant, you still hold potential for credit engagement, because if you're targeted at the right time, you might actually apply for that credit. I know it sounds crazy, but you have to think like a business owner and like an investor, right? So think of like a grandma that's in her 50s or her 60s. She may be a good candidate to be a co-signer on one of her children's mortgage, or a rental application, or a credit card, right? I remember when my mom was younger, like she had me kind of late, I guess, by society standards. But when she was in her 20s, 30s, she would go to my grandma every now and then and say, yo, like I need help with this over here. And my grandma, because she has so much credit on deck, on reserved, she would say, oh, okay, well, let me just go ahead and swipe it. Just pay me every month and we're good. You get what I'm saying? So my grandmother would be considered dormant, right? But something pulls her back into the market, her family or whatever. So though I could see a dormant person being an ideal candidate, to be quite honest. Now, the credit solutionist in me thinks that that's a little predatory if these home loan originators or whatever, if these companies backed by the government start pursuing these older borrowers, I do think that that's predatory. Or if they start to pursue people that have intentionally pulled themselves out of the credit market, it is predatory. Okay, I'm going to stand on that. I just have to. All right, and let's talk about the last group. And again, don't forget to like the video as you're coming in. Once I wrap it up, then we'll go ahead and maybe have a discussion. I don't know. Depends on what the comments are looking like. All right, so let's talk about the people with no trades. So I don't know about these people. Now, the interesting thing about Vantage, let me just talk about this. Let's say you have a credit profile, but all you have are collection accounts. Here's where the Vantage 4.0 might actually help you. The Vantage 4.0 doesn't actually score you based on external public or like external collections. So let's say you have a collection that's paid off. That's not going to hurt you on the Vantage score. On the FICO, though, it will. Because remember, like every client that I've ever had, I always tell them, hey, I don't recommend that you pay off that collection account because number one, there's some legalities. You don't really owe that money, but that's another conversation because we're not trying to get arrested, right? But if you have your FICO credit report and you pay off a collection account, it's still recorded as a collection account. So it's going to negatively affect your FICO score. Crazy, right? So when you think about it that way, y'all, credit is a game. And like, if you don't sit and read, you won't be able to find out when somebody's playing in your face. As a matter of fact, I'm going to show you how FICO and Vantage are playing in y'all's face, but I'm going to do that in just a minute. Let me talk about these no trade people. So no trades are the people that lack traditional credit accounts, but they have other forms of credit that are related on their credit profile. So these are people that don't have anything active, but you're scored based on external collections, maybe public records and inquiries. So they're still looking at your behaviors, but they can't really look at you from a vantage point of, oh, will this person pay new credit lines? We don't know, because all we have to look at is what you've done in the past. Is it starting to make sense how maybe the FICO 10T on that side is not going to really help you because you don't have any good stuff for the last 24 months, but it could help you on the Vantage side because they're not necessarily going to look at paid collections and hit you negatively. They're going to look at the collections that you have that are active and penalize you for those. Okay. So if you have nothing but paid collections, it's going to be a positive. So you would be a no trade person, but you're not necessarily bad because you've paid off your collections. Y'all be knowing, I be trying to find 5 different ways to explain the same thing, but y'all are smart. You get what I'm saying. So here's another thing that I love about the no trade consumer. No trade consumers are people that actually prefer to pay in cash, right? They try to stay out of the credit system. It doesn't mean that they're low income earners. It just means that they don't want to participate in the rigmarole of the credit situation. And I don't blame them for that. I actually find that there are some old school people that are cash only folks. I know that a lot of people that come here from different countries, they're cash only. They have their reasons for doing that too. Some of it is tax kind of stuff. You have girls that maybe work in some industries where cash is king, if you know what I mean, wink, wink. And even those people that they pull in a substantial amount of income, but as long as they report it on their taxes, that's all they care about because they're taken care of with their cash income, right? So just because you don't have trades doesn't mean that you are a less desirable, if that makes sense, right? Like, I'm hoping this is making sense. Another kind of no trade person could be somebody that prefers to keep their debts out of the credit reporting industry or credit reporting matrix. Think about buy now, pay later, which is basically the new age way of saying layaway. Now, layaway, if you think about back when our parents did it, that didn't get reported to the credit agencies because that's not credit. They're basically just putting product aside for you and you make payments on it weekly, monthly, whatever, and eventually you get that product. So some people choose that method because they don't want to pay the interest, right? They know they want the thing, the possession, they just don't want to pay for it right up front, and they also don't want to pay interest. So that could be a no trade person as well. So a lot of people that are doing buy now pay later right now, which is a big chunk of the younger population, they're not recorded in the credit system. So they to a stakeholder, they appear to be potential, right? They have to find a way to market their loan to tie that person in for 10 years, 15 years, 30 years on that mortgage, right? So you got to think about this. Go back to that $1 trillion in portfolios that I told you that this is what they're planning to have once they open the floodgates and let these 5 million new borrowers become eligible. So they're looking at people that have made a concerted effort to stay out of the credit industry. They're going to market to them like, hey, you're underserved, you're underprivileged. Here's a handout. Come on over. Right? They're going to kind of deviate your plan. You might want to pay cash for a house, but they're going to convince you to get that loan. All right. But anyway, the other thing about them, like despite that they lack the credit history, we're talking about the no trade people. You'll remember that your credit score only gets you in the door anyway. Your income and debt to income ratio, that's what dictates whether or not you're going to get approved anyway. So let's say you don't have a lot of trades, but you have a lot of cash on hand. You just might be able to get a home with this new credit scoring model. So I mean, it could work. It could work. So overall, like the breakdown of the newly scorable people, it reflects a diverse spectrum of individuals that are entering the credit ecosystem, or it could be re-engaging people that have been dormant for quite some time. Now, you have to take into account that these shareholders are going to target these people based on their own like personal, what's the word I'm looking for, y'all? They're going to target them based on their specific situation. I think you're going to see an influx of, home buying programs that are, maybe pushed in a certain part of town. Bank of America tried that. I have my own opinions about that, but it's whatever. At the end of the day, they're going to let these people in because it expands their customer base and it promotes financial inclusion, which means money in the pocket of a shareholder. Now, I'm not sold on letting 5 million people be eligible for home loans mitigating risk. I don't think that's going to mitigate risk at all. And I don't think it's going to stop any lenders from participating in discriminatory practices. I mean, a lot of what I'm talking about in this live stream is I'm kind of shooting off the hip here, so you have to forgive me, but I just feel like a lot is being hidden in plain sight, and I kind of want to break down one more thing for you guys before I take off tonight. I was going to talk about the VantageScore, but let me close out some of these pages here, only because I got to stay on task. Y'all already know. All right. So let's talk about it. Okay. So I really wanted to break this down. So we want to talk about the VantageScore versus the FICO score. I think this is so important. And I talk about this ad nauseum on my channel because you need to understand it. So now that the VantageScore is going to become the standard, part of the new standard in the home buying process, I want you to understand how they compare. Now, Vantage on their website, they're pushing their new scoring method like it's the second coming of Jesus, or like it's something new and improved from FICO. Side note, FICO and Vantage are at complete odds with each other because they are competing in the same industry. It's like Coke and Pepsi, McDonald's and Burger King, right? That's what this is. They're two totally different entities that do the exact same thing. Now, FICO has been a staple in credit qualification since the beginning of time, right? Vantage, like I said, is created and backed by Equifax, Experian, and TransUnion. They are kind of like the Amazon of the world right now. They are going to try to get their hands in every single industry. You'll remember, what was it, 2 or 3 weeks ago during my live stream, I talked about how I think it was it Equifax? No, it was TransUnion. TransUnion has their hand in gaming. They have their hands in risk management, which is like their claim to fame. But they also have their hands in so many other industries where they have a stronghold on your identity. The VantageScore is exactly the same thing because they're all in that business together. Vantage is nothing different. Okay. Anyway, let's talk about the differences in these scores. So when you're looking at FICO, we have our 5 classic categories here to calculate your credit score. So FICO says your payment history is going to be 35%. Vantage says that your payment history is going to be 41%. Remember how they said, oh, it's going to help a lot of borrowers. Oh yeah, new people. Yeah, come on down. Not exactly, because you're not going to have enough payment history because you're unscorable or you just got in the credit game. So you mean to tell me that your short payment history is going to be 41% of your entire Vantage score? You're going to fail. I say that with love. Now, the next category, amounts owed. I'm about to show you how Vantage is playing in your face. So amounts owed for FICO is 30%. Now let's go over to the Vantage score side. Do you notice that you don't see anything here that says amounts owed? Well, that's because they basically just tried to make you think that they're not going to look at it, but they totally are. So here are the categories that amounts owed falls under. Balances, which is 6%. Okay. And then credit utilization. You're already looking at 26%. Okay. So you're getting real close to that 30%. The other factor that you're not taking into consideration is that credit utilization automatically has available credit baked into it. So your amounts owed on the FICO side is your credit versus the amounts that you owe. That's what comes into that 30%. Vantage was so slick with this. I got to give them credit because credit utilization, balances, and available credit, that's all counted as your amounts owed. It comes into play for all of those categories. So if I do my math right, that's 26 and 8. That's 28% total. Not too far off from what we see on the FICO side. Y'all stay with me. I know when I start talking numbers, people zone out. Let's talk about length of credit history. 15% on the FICO side. Now, if we look over here, I don't see anything on the Vantage side that actually says length of credit history. But your girl went to the Google machine and asked the question, because I know on the Vantage side, I'm looking right at it, but it just isn't saying what I need it to say. So length of credit history on the Vantage side is depth of credit. So length of credit history is only 15% on the FICO side, but it's 20% on the Vantage score side. So you remember that article with Vantage where they said, oh yeah, don't worry about it. If you don't have a lot of payment history, you don't have a lot of history as a whole, it's not going to matter over here. Yeah, right. I just literally told you payment history and depth of credit, which is credit length. That's a whopping 61% of your Vantage 4 score. How about that? That's kind of crazy. And if you need some extra backup, here is the depth of credit definition right here. How long you've been using credit. There you go, guys. So the length that you've had an account still does matter on the Vantage side. And it actually matters more on the new Vantage side than it does on the FICO side. Go figure. So let's talk about new credit. On the FICO side, it's 10%. And then your new credit is 11% on the VantageScore side. So I'm going to say they're pretty much neck and neck, because this is going to be a factor no matter what, because they want to know if you have recent credit, are you using it? Are you in the game? And if you are using it, are you a responsible borrower? We need to know these things. So that's why it's still a factor with the VantageScore. Now let's talk about credit mix. That's the last one on the list here. Now, the pro to not having the credit mix on the VantageScore side, the pro here is that, let's say you only have credit cards and you don't have any installments, you don't have any student loans, you don't have any car notes, you don't have a mortgage, nothing that shows you can pay off a set amount every single month or make a monthly payment. If you don't have that kind of history, that can hurt you on the FICO side. But on the VantageScore side, it doesn't actually affect you one way or another. Now, I'm not sure how I feel about that, because I do think you should have a pretty good credit mix before purchasing a home. The lender has to know that you can handle bills that fluctuate, which is revolving. So think credit cards, personal loans. I would say a personal line of credit. So that's a little different. So you're able to responsibly handle debt that can fluctuate on the revolving side. A lender for a mortgage also needs to know that you can handle paying that same amount on an installment note every single month. Because if you think about it, when you get a home, your costs are going to fluctuate every single month. So your mortgage will stay the same, true, right? But you're going to have other costs to take care of your home. That's where that revolving history comes in. So if they don't care about it on the Vantage side, to me, that's kind of why they still have the FICO 10T model that's going to be required, because the lender still does have to look at your credit mix. So I just want to make sure, looking at Vantage, don't think that it's like easy street, right? Because it's really not. That's not how this works. You're still going to be held to the same standard. And you'll remember from the other screenshot that I had a minute ago, the lender still has the option to use the tri-merge method. They just have to make sure that in that tri-merge method, they're using FICO 10T and Vantage 4.0. If they want to add something else to that mix and still look at those old FICO scores, they can. So you got to remember that, okay? I'm only giving you this information because I want you to see how some lenders will seriously play in your face. Let's go a little bit deeper. And then I'm going to go ahead and wrap this part up. So let's talk about what influences the Vantage score. I literally just broke it down to you guys over here, but then they say something totally different here. So let's talk about what's extremely influential in your Vantage score. Your payment history. Remember, that was that 41%. And of those prime Vantage scores, these people are between 661 and 780. 90% of those people pay their debts on time. Now, with this VantageScore method, they're trying to get people with 620s in. So that's a whole nother conversation for another day. I'm not going to really talk about that. Let's talk about what else is highly influential. Credit utilization. Credit utilization. Let's go back over here. You see how they just say it's 20%? But here, it's actually pretty high. It's actually pretty high. 20% is not, to me, not highly influential. But this article says something different. But anyway. So the length of credit experience and credit mix also play a large role in determining your score. Remember how I told you over here, they try to separate these numbers to try to make you think they don't matter, but they are judging you on the combined total. So you're still looking at a FICO scoring method, but it's just called Vantage, okay? And then moderately influential are your new accounts. Maybe, maybe not. And again, I guess that makes sense if they're looking at those folks that are the unscorable or the new credit people. And then let's talk about the less influential. We're talking about Vantage here. Amount of credit available. Lenders like to see how low balances and significant available credit. Bull crap, because I don't believe that your available credit means nothing, because your utilization, your available credit, and your balances are all considered during the home buying process. Please do not look at this chart and be thinking, yes, I can run my bills up and I'm still going to qualify because I pay my bills on time. If you go by just looking at the VantageScore side, you know who's going to come and uppercut you while you're not looking? The FICO 10T. That's how they're going to get you, right? So as well-informed consumers, I want for y'all to look at every facet, okay? Anytime it seems like there's a handout, trust me, is, how do I say it? It's not as good as it looks, right? It's really not as good as it looks. So I want you guys to, when you see these videos on YouTube, because I saw a couple and I was like, yo, why are they only telling half of the story? When I saw that, I was like, okay, let me at least get on here and just try to shoot from the hip and talk to my people and tell them what they need to know. But yeah, y'all, I do think this is going to be a good idea, but I also think that you're going to have to talk to an expert in the field to understand how to play this game. So of course you have me. You can book me over at mycreditcall.com for sure. And I'll definitely help you navigate this as the time comes, because I think we do have a little while before this is implemented. So you do have time to fix your credit score. So you want to talk to a credit repair specialist. I would definitely love for you to work with me over at PX Credit Solutions. But you can always work with whoever you want. It's up to you. But you know, I'm here. Like I said, I'm sitting here with my little glass of wine and my bonnet, and I'm about to log off and continue on with my night, because, you know, all I'm here for is to give you guys the information and do what you will with it. This is not financial advice. It's just one person wanting to help you all secure your financial future. Seriously. That's all that this live stream was about. So hopefully if you go into the home buying process, you feel a little more educated by listening to this live stream tonight. Definitely give us a like on your way out and all that good stuff. I will look to see if there are any comments here, and then I'll get into those, and then I am going to peace out. So let me see what we got up in here. Okay, so it looks like we have Deborah Anderson. I'm not sure if you guys can still hear me, but yeah, I've worked so hard to get all my credit scores where they are today. And now they're coming up with a lot of BS now. I have my FICO, which I pay $31.75 a month for my correct scores. Deborah, I've never seen your name before, but I'm very glad that you're here. And it looks like you're the only person that commented tonight. So look at you. You definitely get a star tonight. Yeah, it's a lot of BS. The scale is sliding. You'll find that in finance. That's typically what happens. They're always going to change the rules, but because FICO, Equifax, Experian, and TransUnion have been around since the beginning of most of our lives, that's pretty much what you're gonna find in these situations. So that is pretty much it. I don't even know if you guys can still hear me. As a matter of fact, let me check and see. It looks like I should be all right. But yeah, the sliding scale is always going to be there. So I would say keep your 31.75 a month for FICO, because that pretty much is going to be the standard for a very long time. Please do not get caught up in these videos where people are saying, oh, FICO is going to disappear. No, the heck it's not. It's been around for like 50 plus years. It's not going anywhere. And like I said, even though they're switching to the buy merge method where there's going to be two different, they're going to use your FICO 10T and then they're going to use your Vantage 4.0. You still have to remember that your 3 credit scores are still baked into each one of those particular scoring models. So it's kind of like they're just doing semantics right now, where they're trying to tell you one thing, but the system really hasn't changed at all. And like I said, I think if anything, it's really just something that they're doing right now to try to boost the housing market, because people are not purchasing houses and they need for those applications to come in so they can start approving people. In my opinion, it's probably going to end up being just like 2005, where they're going to approve a whole lot of people that have no business having homes or home loans because they cannot afford it. They are new to credit. They do not have a long, extensive history of paying bills. And they also do not have the income to prove that they can stand the test of time. It's pretty much just a disaster waiting to happen. Hold on, y'all. I got to make sure my audio is right. I don't know. Okay, you can hear me. Okay, I just had to make sure. But yeah, that's all that's going to happen. So, I mean, you're doing okay. Don't let anybody on YouTube or anybody out there convince you that you're not doing the right thing at this point. You are. So keep doing what you're doing. Pay your bills, keep your utilization very low, because as y'all know, as long as you're under 30% with all of your amounts that are owed versus your credit available, you are going to be fine. That's the beauty of the credit system. It's just numbers. If you take some time, just do a little research, go through some of my videos, it'll make sense. It's not as complicated as they make it seem. Anyway, y'all, thank you so much for stopping by. And thank you for like the 5 or 6 of you that hung out this entire time. I so appreciate you. May or may not get on camera this week. I don't know. Depends on how I feel. You know, I'm a little like the weather or the FICO or the VantageScore. I do what I want when I want. Anyways, guys, I'm so happy that you came through, but I have to go eat dinner now. And honestly, I'm tired. I think I'm done here. I'll see you guys on the next video. Don't forget to give me a like before you head out, and I'll see you guys next time. Credit Solutionist out.